We're back in business. We were talking about M&A deal activity for 2013. HV Harish of Grant Thornton is back with us. Harish, I was asking you about the volume of deals that we've seen this year. Would you say it was tepid both in volume and value terms?
Well, I think we've reached some moderation in the growth of the M&A market. We've reached on an average about 1,000 deals a year over the last 3 years, and we haven't been able to cross that. Values have dropped probably in line with the general economic condition. But there are segments which are looking quite good. I think the story of the year, in my opinion, would be the growth in private equity activity. We've seen a growth from about $7 billion to $10 billion, average deal size going up from 18 to 25 million, in spite of a, shall we say, weak economic outlook, in spite of the depreciation of the rupee. Private equity continues to hold. Cross-border, we are seeing larger outbound deals compared to previous years, though the number of deals have fallen. So it's a clear sign that India Inc. is again looking out to invest. Inbound has sort of slowed down. Sure. We aren't seeing so many. The big ones are really Unilever and the recently announced Glaxo.
Right. I was just going to come to that, Harish. Some of these deals we've seen are largely in the public market. From what I understand, you're saying that you're seeing some activity in the private equity space. But some of the private equity guys that we speak to say, look, there are deals. I mean, but there's always a problem of price because existing promoters don't want to exit at the price because they're waiting for the markets to recover. Secondary PE exits are also becoming extremely difficult. The IPO market is dead. How then would you look at the PE market in 2014?
Correct. Well, I think if I look at PE market in 2013, like I said, the values and volume has increased, and it shows that investors are still looking positively at India. Clearly, IPO market is dead, as you pointed out, but there are exits happening at the strategic exit level. And if you see over the last few years, there aren't other sources of funds for promoters. So they are easing up a little bit on their valuation expectation. There are challenges for the private equity, significant challenges, but that hasn't stopped them from increasing investments. They're looking at things like buyout. You mentioned Hexaware. So they are adopting the strategies, but they continue to have faith and confidence and increase their investment in this country.
If you look,
so they probably are taking a long-term view rather than a short-term view on the market.
Sure, but if you look at individual sectors, which sectors do you believe are ripe for M&A activity?
Yes. Well, I think the classic sectors that are active in M&A and continue to be are the soft sectors, what I would call the healthcare, pharma, the technology sector. And they continue to be dominate both the private equity as well as the M&A space. We aren't seeing so much activity in the M&A in the manufacturing space, which really needs to pick up significantly.
One area that many people argue is about funding costs, their ability to raise money to do any of these transactions, Harish. Do you see that changing? Do you see the environment becoming a lot more conducive for deal making?
Well, I hope so. Hopefully the RBI governor signal and inflation pressures will come down, so some funding would ease. But India is a strange M&A market if you really look at it. Banks are prohibited from lending to anybody for M&A. This is a fairly unique situation. Hopefully that will also change. But for the last so many years, people have had to do M&A out of their funds, out of private equity, or out of international debt. So clearly it's an opportunity for international debt, but something that is shut out from the Indian banking system, which makes it much more challenging and more expensive to do M&As. And, probably, I hope next year we will see some change in the regulation from Reserve Bank to encourage domestic M&As. And I think change of control is a good thing. It would help companies revive and pay back loans to other banks. So that's something that RBI should really look at.
One final question, Harish, and this is largely to do with rules of the game. Many people argue that some of the rules, the regulations as far as Indian M&A environment is concerned, is extremely cumbersome. There's always confusion from different regulatory authorities. Has that, in a sense, simplified? With the new takeover code, has that, in a sense, become a lot more easier?
I would not agree with that. I think one of the key things, and this is something I've been saying for the last 4 or 5 years, that I hope next year we'll see some hostile transactions, because I think clearly we need to have a good market for control, and that is completely absent in the Indian market. Of course, we are a regulatory heavy market for everything. There are a huge number of processes to complete, which makes deal making quite cumbersome, and unfortunately that has not changed. So there is no ease up on the processes, and I would argue that if the government actively encourages control deals, hostile deals, the shareholders of India Inc. would see a lot more value in their investments.
Harish, good talking to you. Many thanks indeed for joining us with your views. That's the view from Grant Thornton on the M&A deal making in 2013. Up next, decks have been cleared for Reliance Industries.